Welcome back. In this video, I'm going to be showing you a full guide to top-down analysis and everything you need to know to determine daily bias. One of the most common questions I get is how do I avoid getting lost in the lower time frames? How do I avoid being a pattern trader, right? I'm always buying this fair value gap, but it never works. And let me show you what are the components that are actually going to make your trades work, your entries, your models effective in your hands. So the aha moment many of you are looking for is a comprehensive understanding of top-down analysis. Whenever I get asked, what's the secret to trading? There is no secret, but the closest thing I can give you to that is this teaching I'm about to give you right here. In this video, you will learn how to have an institutional perspective on price and prepare for the day/week ahead. When I say institutional perspective, what does that mean? Institutions are working off higher time frame monthly, weekly, daily charts. So we absolutely have to be mindful of what those higher timeframes are indicating so that we can trade with an institutional perspective as retail traders and have precision that most can only dream of. So top-down analysis is how we determine the draw in liquidity. As traders, what we need to understand is the draw. Where is the market drawing to and why should it go there? Because once we can determine that, then we can frame our entries and our trade setups. But until we have the draw in liquidity, nothing else matters. So this is how you determine the draw in liquidity with the most consistency and precision. Many traders' obstacles when first learning these concepts are, as I mentioned earlier, pattern trading without an understanding of where the market is drawing to top down. So what does that mean? Right? Well, you get in the charts, you see your fair value gap, you see your optimal trade entry, whatever model you're using, your order block, and it doesn't work like it does in the hindsight teachings that we learned from. Why is that? And that's because you're missing an understanding of top-down analysis, which tells you where the market's actually even going. Because unless you know where the market's going and drawing to, you're just a pattern trader. And this analysis will help prevent you from becoming a pattern trader. And what is a pattern trader? Right? A pattern trader is someone who goes into the charts, doesn't know what they're looking for, why they're looking for it, and they're just hoping their pattern is going to flash across their screen. This is one of the most ineffective strategies because there's no logic and rhyme and reason to why you're taking the trade setups you're doing. You're just hoping your pattern is blindly going to work that day. And that's why you probably have a low strike rate and you're not seeing consistency. One of the biggest components in top-down analysis is time frame alignment. Top-down analysis allows us to align the time frames we are analyzing for the best trades. Timeframe alignment is an idea that I use to frame high probability setups. Through experience, I have learned that the best setups occur when all timeframes are aligned and pointing in the same direction according to my analysis. And the reason this is helpful is because paint a scenario here in your mind, right? You're sitting down, you're looking at the charts. The weekly chart is clearly indicating it wants to reach higher. The daily chart indicating it wants to reach higher. Hourly, 15.5, all showing bullish market structure, bullish order flow, and pointing to a liquidity that's above market price. Now compare that scenario with this scenario here. Weekly chart, it could go anywhere. It could go up, it could go down. Daily chart, I have no clue. 15-minute or hourly is bullish. 15-minute is bearish. 5-minute, I have no idea. And the 1-minute, there's a pattern that I'm going to trade. What results do you think that's going to give you? As opposed to the first scenario where everything's in alignment. And that's the power of time frame alignment. Because one of the issues that many traders have is they're seeing things in lower time frames that don't make sense in the higher time frame. So what you want to do is have top-down analysis. And then if you have time frame alignment behind your trades, you're going to notice cleaner, low resistance liquidity runs because you're trading in line with institutional order flow. And you're going to notice a higher strike rate in your trades because the trades you're taking make sense and they flow within the understanding of top-down perspective. Flexibility. One of the biggest things in trading is being flexible. Understanding top-down analysis will allow you to be fluid in your analysis and pivot as the market provides new information. Why is that so important? Because many times we'll have a bullish bias or we're looking for higher prices from our pre-market analysis. But one of the key things with the market is being flexible, allowing ourselves to pivot and adjust to what the market is giving us. So every day when we sit down at our desk and we're doing our top-down analysis, as you're about to see in action, we want to be able to be flexible and pivot with the information that the market is giving us. And you're going to see how top-down analysis allows us to pivot and be flexible. So now, how do we implement this into our trading? Well, the first thing is professionalism. Because being a good trader, being a precision-based trader, it requires a lot of concentration, focus, and effort. And anyone that's telling you otherwise is absolutely lying to you, because it does require you to show up on time, even show up early, stay after, do review, put in the work that people that aren't professional aren't willing to do, and their results are going to reflect that. So we must show up early to have everything ready for our trading hours, right? This all goes back to that conversation around professionalism. If you want high-level results, if you want results that most can only dream of, then you have to be willing to put in the work that most aren't willing to do. And most aren't willing to get to the session early. Most aren't willing to prepare themselves and do everything they need to do 20, 30 minutes ahead of the trading session so that they can be ready to go come game time, come the opening bell, right? And then again, precision-based trading again requires focus and concentration. One of the things that I laugh about all the time is we can't just wake up 15 minutes before the market opens, do our pre-market analysis on the toilet while we're taking a shit, and expect professional results from that. It just doesn't work. So what we have to do is get up. For my morning routine, it's getting up an hour before market open, getting outside, going for a 20, 30-minute walk, getting sunlight through my eyes, right? Waking up my mind, getting to the charts at least 25 to 30 minutes before my operating hours. Do the top-down analysis you're about to see me show you step by step. And then once I implement all those factors in my trading, I'm prepared, I'm focused, and I'm dialed in come open. And then who I'm competing against is uninformed money, who's not doing any preparation. They don't have any focus or concentration with their trading, and they're just showing up at market open, hoping they get lucky. You tell me who's going to win that battle. And that's one of the things that I focus on constantly when I'm coaching and training, is having professionalism behind your trading, right? If you want professional results, you simply have to act like a professional. So now we'll get down into the top-down analysis itself, starting with the highest time frame. Daily time frames. So our daily chart are used for higher time frame analysis, giving us a daily bias to work within for intraday trading. So right away, the daily time frame is going to give us a reference as to what we should be looking for intraday, right? And one of the keys with the daily time frame, which from what I see many traders spend the least amount of time on, is actually the most important component to your trading. Because looking at this daily candlestick here, if it's a upward expansion, what do you think is going to be more successful in terms of trading models? Buy models or sell models? Obviously, buy models. But when we're in the session, while we're trading, right, we're in our operating hours, many times it's easy for traders to forget this. And then we're taking a whole bunch of short setups in a bullish day. And one of the keys to combating that is understanding what the daily time frame is reaching for and working within that intraday. So what we want to determine from the daily chart as well is determine what key levels this time frame is reaching for, either higher or lower. In this example, we're going to be looking at a bullish example. So we're assuming there's either liquidity or inefficiency above market price that the market is drawing to. Right? So in this example, we're going to be using a bullish scenario. This time frame is where I frame key levels I will be using for my trading session. So on the daily chart, I'm marking out key areas of inefficiency, liquidity, wicks, order blocks, breakers. All key levels that I'm using on the daily time frame are going to be transposed into my intraday charts as well, but I'm getting them all from the daily time frame. And again, one of the reasons for this is because the highest probability setups will form off weekly, daily levels. That's a very important one. I'm even going to say it again. The highest probability setups will form off weekly and daily levels. So if you have your key weekly, daily levels and you look at them in your lower time frames, you're going to see that's where your best trades and your best setups are forming. The most explosive runs, the cleanest runs are forming off higher time frame key levels. So a lot of times I get asked, how do you keep your charts clean? How do you keep them streamlined? I'm just using daily higher time frame key levels. And then as I work through my time frames, I'm looking at those levels intraday. And you'll see again examples of this with real-time price action on the right side of the chart. All right, so now from the daily, we work our way down to the hourly. Again, it's top-down analysis. So going into the hourly time frame, the hourly chart is used to read the market structure and order flow and confirm what we see on the daily chart. So again, the daily chart, we already have a bias as to what we're looking for. In this case, it's bullish. So what we're doing on the hourly time frame now is we're going to read market structure and order flow to confirm what we're already seeing. So if that daily chart is indicating it's bullish, what we're doing on the hourly chart is confirming that the market structure and order flow is also bullish on this time frame as well. What does that look like? Well, for order flow to be bullish, we want to see swing lows traded to and rejected. We want to see highs displayed through, and we want to see down close candles and inefficiencies supporting price. That's a basic rundown of institutional order flow. There's a lot more levels to that analysis and order flow, but just from a basic standpoint, that's what we're looking at. So order flow is clearly bullish on the hourly chart, which confirms what we want to see on the daily. And again, this is the time frame I use for my session bias when trading intraday. So whenever I'm framing a bias for the session, like for the AM session, do I want to be a buyer or a seller? Or for the PM session, do I want to be a buyer or a seller? Well, what I'm looking at is the hourly time frame. And I'm using this for my bias as to, do I want to focus on, again, higher or lower prices in the session? And what I'm determining that based off is the hourly time frame. And then I'm mapping out what liquidity or inefficiency is this time frame reaching for, right? So we're doing that on the daily chart. So we're already expecting it to deliver either higher or lower to some liquidity or inefficiency on the daily. And then we're simply refining that to the hourly time frame. 15-minute time frame. So from the hourly, we transition to the 15-minute. So the M15 or the 15-minute is the most helpful time frame for intraday traders, allowing us to see where the obvious liquidity is and where it will be targeted. I get lots of questions on how to not get lost in intraday price action. A lot of times, like I said, I'm seeing all these market structure shifts on the 1-minute chart, and I'm always losing on these setups. The key to that, the answer to that, is understanding the 15-minute time frame. Because when we have a 15-minute chart, and assuming we, again, are labeling the obvious liquidity, we can see here's the obvious liquidity for this example. You just have to take my word on it, and you will see this real-time example here when we go into the live examples that I used this week. So assuming we have liquidity pools here and here, the daily is already communicated it's bullish. The hourly order flow and market structure is also bullish. So now we're using the 15-minute to frame our liquidity that's likely to be targeted. So that would be here, here, and here. So when I have all these factors, before we even go down into the 5 and 1-minute time frame, what am I filtering already? Shorts. If that daily's bullish, the hourly's bullish, and the 15 minutes indicating it's reaching higher, I'm not looking to take a 1-minute market structure shift to the downside. So this is how you avoid getting lost in intraday price action. And it's getting to the charts early, being prepared like a professional, having your top-down analysis, everything ready to go, and then come 9:30 open or whatever your operating hours are for trading, you're now dialed in and ready to go. And you're not getting lost on all these intraday price fluctuations. For example, this down close candle here on the 15-minute here or here may look like on the 1-minute, this thing's going to drop to 0. But all you're noticing is it's just retracing to a 15-minute fair value gap here and here. And the way you avoid, again, getting lost on 1 and 5-minute charts is keeping the 15-minute as a frame of reference throughout the day. This time frame confirms our analysis and setups on the 5 and 1-minute, giving us a clear perspective and avoids getting lost in the lower time frame price fluctuations. So what am I saying there? Whenever we have a trade that we like on the 5-minute and 1-minute, we're going to confirm and validate that trade with the 15-minute, because this is going to be the exact key that's going to help you avoid getting lost on a 1-minute market structure shift lower, seeing the 5-minute print 1 or 2 down close candles and think the bias isn't valid anymore. When in reality on the 15 and hourly, nothing's changed structurally, everything's still to the upside, right? And the key is on that 15-minute chart. So many times when I'm in a 1-minute trade, I'm in a 5-minute time frame trade, I'm using the 15-minute to manage it. Because again, as long as everything's bullish on the 15-minute, then I'm staying with the bias that I'm looking for, right? And this is how you avoid being a pattern trader and again, getting lost in intraday price action. And then from the 15-minute, we then work down to our 5 and 1-minute, right? So once our top-down analysis is completed and we see the timeframes are aligned for high probability trading, we use the lower timeframes for entries and managing risk. So again, assuming top-down, the market is bullish, everything's pointing higher. Our operating hours start here at 9:30. We see the market drop into sell side when we're bullish. We want to see that. And then we can use this fair value gap here to go long. It doesn't give an entry. That's fine. this fair value gap here, go long. Because what's it drawing to? We've already determined on the daily, hourly, and 15-minute that this market is reaching higher. So we can use any discount in the lower time frame to go long and ride in the liquidity, ride the move into the liquidity. Same thing here, fair value gap, trades into it, expands higher into premium levels that the market would already be drawing to. In these lower time frames, we can also manage the trade and read order flow. So whenever we're in a long entry, because again, the higher time frame is telling us it's going higher, we can use these time frames for entries, but also reading order flow as well. What does that mean? Well, if we're bullish, we want to see what? Down close candles here, supporting price, and inefficiencies supporting price. Here, market drops down, finds support, expands higher, small inefficiency here, drops down into that, finds support, expands higher, fair value gap, expands higher, down close candle, trade into it, expands higher. So everything communicating bullish order flow. So now you get your entry based off your top-down analysis, but then how do you trust the trade? And it's what I just shared there, reading institutional order flow. Because as long as those factors remain true, and inefficiencies, below market price, support price, and down close candle support price, the market will more than likely keep gravitating in your favor, and you can trust the trade. And then last thing I wanted to touch on here about managing risk. One of the reasons why I like these intraday timeframes, and no, it's not noise, absolutely 1 minute and sub 1 minute timeframes can be traded with precision. You're about to see an example of it here real time. But one of the reasons why I like it is for the risk management standpoint. Can I trade a hourly or a 15-minute chart with the information that I'm teaching you? Absolutely. But one of the reasons why I like these lower time frames is the precision element it gives me, which is small stop losses. I personally like to have very low risk and nice rewards on the trade that I'm targeting. The only way I'm able to frame that is with 1 minute and sub 1 minute charts. So I can have very tight risk, and as long as I know where the higher time frame is going, I can have these monster trades with little risk, high reward. But the key is understanding time frame alignment and also being patient, because it's not every day the market's going to deliver these types of price runs here. But when all the stars align, like I'm teaching you here, the daily, the hourly, 15, 5, 1 minute, you're going to have these beautiful trades. And that's what you want to take advantage of. These are the runs that we want to capitalize on. And then pro tip here, study your losing trades. And you will see they often made sense only on the 1 and 5 minute, but the higher time frame was not in agreement. This is one of the biggest epiphanies that I had when I was reviewing, journaling, and reviewing my trade setups, was my losing trades. There would be a 1 minute pattern, like, yeah, there's that fair value gap or order block I look for. But then I would look at the 15, the hourly, and the daily. And I'm trying to sell short a daily bullish candle or hourly bullish order flow and market structure. And then what I ended up realizing was that my losing trades were a result of not understanding what the higher time frame was doing. So I've built in these concepts and protocols that I use now in my trading every single day, which is top-down analysis, and making sure my lower time frames are always rooted in higher time frame analysis. And that's how I was able to overcome being a pattern trader when I first started 3-4 years ago, using just optimal trade entry, right? Actually 4 years ago with the optimal trade entry, right? Just be looking for this optimal trade entry pattern all the time. But then what I realized through experience, through journaling, was that it's not just the pattern. It's not just the optimal trade entry that's effective. It's understanding how all that comes together with top-down analysis. So with that, now let's get into the live price action and see how this is applied. Before I get into that, I want to share a little more on why I like to use these types of examples for my teaching. Yes, I could go into static examples that have already happened, but I think that's very ineffective. One of the things that I see is missing across this entire industry is educators actually using what they're teaching and what they show works for them. And that's one of the things that I never see is traders actually using what they teach. So for me to fill that void, right? If it's not there, create it. So for me to fill that void, when I teach something, of course, I have to have static images to show you the concept, right? Because that's how you get the foundation. But now how do you actually get confidence that this stuff works? You have to see it applied. There's no other way you can possibly learn that. And in my opinion, that's why this industry has such a high failure rate, because most traders aren't actually learning from people that can do what they teach. So again, want to look to separate ourselves from that, give you guys what you need, and fill in that void that I see is missing in the industry. Longer term, like weekly, monthly chart, I'm still not calling it top in this market. However, on the daily time frame, we see this fair value gap here. It's really having a hard time getting up through that. We tried once, twice, three times, and not showing strong willingness to want to get above even mid gap of this fair value gap here. So as of right now, I'm neutral because we're in a range to bearish based off what we're looking at here in the lower time frames. So key levels on the downside that I have, these premium levels here, Monday's high, previous day's high, I don't think that's going to be a factor. At least it's not for the first few minutes, but they're there if we need them. This wick here, I'm just using the most recent one. That's the discount wick, consequent encroachment. That's going to be a key level for me. If I really wanted to take it one step further, I could also have this wick, consequent encroachment here. And then that in and of itself creates a PD array, almost like a fair value gap. And then we have this small volume imbalance here. And then we have these relatively equal lows on the daily chart, one of which is previous day's low. Make that a bit bigger so you guys can see that. So previous day's low, obviously key liquidity pools that we're working with just about every day. And then below that, we have another small pool of sell side. So hourly time frame, again, the damage has already been done to the upside, equal highs here, here. Markets trade up into that, and we broke back down into the range. So far, order flow is bearish. We have the 2 discount wicks here that we're trading in right now. Again, if we start to accelerate through that, we have that daily volume imbalance in gray. That's also a downside target for me. And then we have the equal lows, which is, again, previous day's low and Monday's low. So to the downside, that's what I'll be looking for as discount targets. All right, 15-minute chart. So London taking out the highs here, turtle soup, which is what we expect in London. Heels up, market then breaks down. Fair value gap breaker respects that, breaks down, up close candle, trades up into that, respect that. That's also a lower quadrant of the daily fair value gap. Market's respecting all these levels and still accelerating to the downside. So order flow remains bearish going into this session. We have the sell side here in that 15-minute fair value gap. We have this 15-minute fair value gap here in white, which I have labeled here, which is this candle's high, this candle's low, and this inefficiency extended through. Why do I have that? Because if we're going to get down to that daily volume imbalance and these equal lows, then I'd want to see us trade down through this fair value gap, use it as inversion, resistance, and continue to sell off, right? So that's why I'm working with that level in here. All right, so you're using that close proximity short here to that fair value gap. And this thing should rip into my limit orders, and it did. There we go. There's the executions. Put labels on here, and then just covered 3 below that 358 level. So daily volume imbalance that's here. The market trades down into it, using it as support. The premium wick here that we're measuring that we've had on our chart for the past few days. We've done what we've traded through it, and we're still expanding higher. So this is all communicating bullish institutional order flow. Yeah, so daily time frame, we have the buy side, previous day's high. It's not technically the previous day's high, but I use that word interchangeably for the last 3 days highs and lows. So we have Wednesday's high here. That'll be a nice draw if we continue to accelerate on the upside. And then through that, we have this swing high here on the daily chart. Will we make all that ground today? I'm not willing to co-sign that. I'll see how we traded each high. And then with you guys know how my style is, I'm reading order flow each step of the way, and it'll tell me if it's going to get up to that high. So we'll go and speed through this. So yesterday, again, very unclear for me because we're in the middle of the dealing range, but now we're leaving the range to the upside. So usually the most energetic move that we get out of a consolidation is typically the direction it's likely going to choose. So we displace higher, daily volume imbalance, use it as support. Low end of the daily fair value gap, we drop down, support, expanding higher, closing above lower quadrant. And now we have the previous day's high here, which is Wednesday's high. And then we have the intra-week high here, which is Tuesday's high, right? And as long as order flow remains bullish, looking for these higher time frame levels up here. All right, so 15-minute time frame. Here we can see again Wednesday's high, Tuesday's high. And then again, if we accelerate through that, we'll have, that's a lot of ground for the market to cover, but we'll see. And then if we really start to accelerate to the upside, then we have all this buy side back over here. But low-hanging fruit is the targets that myself and my team have already shared, which are just going to be these close proximity buy side liquidity pools, the Wednesday high, and then the intra-week high currently. And then you can see that's what would have given you the framework for today. Thank you guys for watching. Hope this video was insightful for you. I wanted to get this one done because I have planned to teach my full protocols for the AM session and the PM session. But before I did that, you have to understand the basics of top-down analysis. Because if you don't know top-down analysis and you're not applying it in your trading, anything else you learn is going to be ineffective in your hands. So I wanted to get this one out first so that you guys can have this, so that next week, as I'm going into my protocols for the AM and the PM session, exactly how I trade them step by step, I want you to have this first so you can have this as a foundation to then take in that information and start applying it effectively. With that, again, I hope this video was insightful. If you want to see any additional topics, concepts you want me to touch on or share, comment down below. I will look to get those made for you guys. Have a great one. Thanks for watching.